The Federal Reserve Bank plays a huge role in the massive economy of the United States. The majority of the U.S. population has no idea what the Fed does to regulate the economy. The Federal Reserve System of the United States monitors and controls the economy in three major ways. It controls interest rates, controls the money supply, and oversees the banking system. To start off, let's look at how the Federal Reserve is made up and their key functions. The Federal Reserve System is made up of 12 Federal Reserve banks. The United States is split into 12 districts, with each Federal Reserve Bank serving as a central bank for each district. The Federal Reserve Bank in New York City is the most important not only because it is centered right on Wall Street, but because it has many powers that the other district banks do not have. The 12 banks are overseen by the Board of Governors. What is the Board of Governors? The Board of Governors consists of 7 governors who are appointed by the President and confirmed by the Senate, who serve 14 non-renewable terms. One governor is appointed as the chair by the President himself and serves 4-year terms. Janet Yellen is the current chair, and she took office as the chair of the Board of Governors of the Federal Reserve System on February 3, 2014, and her term ends on February 3, 2018. There is another group of members of the Fed that make important decisions as well, the Federal Open Market Committee, or the FOMC. The FOMC has 12 voting members that decide on important monetary policy decisions. It consists of 5 governors from the Board of Governors and 5 presidents of the district banks, which rotate yearly. They meet about 12 times a year. One of the most important ways that the Fed controls the economy is by controlling interest rates. Interest rates are important because they set the cost of borrowing and the reward for lending. The Fed can raise interest rates to slow down the economy and vice versa. If the Fed increases interest rates, the cost of buying, let's say, a house or a car increases because of the increase of interest on the loans. If the Fed decreases interest rates, the cost of buying a house or a car decreases, and businesses would also borrow more money and think of hiring more employees if consumers are spending money. The Fed controls the money supply by implementing monetary policy. There are 3 tools of monetary policy. The first, open market operations, or OMOs, have 2 parts. Open market purchases are when the Fed buys treasury bonds from large banks. The Fed pays for securities by giving reserves to the banks. Then the banks make loans with these reserves. Multiple deposits will be created, and the money supply increases. The second part of open market operations are open market sales. This is when the Fed sells securities to the banks. The banks pay for these securities with their reserves. Effectively, the Fed takes out reserves from the banking system and the money supply shrinks. The second type of monetary policy is adjusting the reserve ratio, which are changes to the money multiplier. The money multiplier is the maximum amount of new money created by a single dollar of excess reserves. Lowering the reserve ratio increases the money multiplier, which increases the money supply. Increasing the reserve ratio lowers the money multiplier, which decreases the money supply. The third monetary policy is the discount rate. The discount rate is when the Fed acts as a last resort lender to the banks. Increasing the discount rate discourages the banks from lending, which shrinks the money supply. Of the 3, open market operations are the most influential and the most important. The last time the Fed changed the reserve ratios was in 1992. There are 2 types of monetary policy, expansionary and restrictive. Expansionary monetary policy is implemented when the economy faces a recession. In expansionary monetary policy, the Fed will lower the reserve ratio and the economic growth will pick back up. Restrictive monetary policy is implemented during periods of rising inflation. The Fed will sell securities, increase the reserve ratio, and raise the discount rate.